Good afternoon and good evening. So this will be a market review for today's trading. This will be a market review for the 23rd of September 2024. Right. So the previous week's trading, we already rallied higher to take out this buy side liquidity on the weekly time frame. So going into today's trading, because from the economic calendar, we have AI impact news driver today's trading at 9:45 a.m. So because of that high impact news, we participated in today's trading, Monday's trading. So when you have an objective reached like this or the other time frame, you are more interested in scalping the lower time frames until the market gives you more information on the higher time frame. So using just this information which is being delivered on the higher time frames, you will need to go to the lower time frames to get a scalper's condition. The previous day's trading, which is Friday's trading, we had these down close candles. So we are interested in the high of the candle and the low of the candle. So that is our range we are currently working inside of for this Friday's trading. So we have buy side liquidity resting above here, and just below here we have sell side liquidity. So going into the lower time frames for the intraday trading market idea, we had Sunday's open here, this down close candle here, then price rallied higher after Sunday's opening price. So here we would want to indicate the Sunday's open, which is this. We make this a gray color. This, what is being explained here, is the inner dialogue I had going into today's trading. So here we have the Sunday's opening price. So we rallied higher here, and then Monday's open was here, these up close candles. So here was the midnight opening price for today's current day's trading. So we have to indicate that here. So we have the midnight opening. All of this opening price is very vital in understanding and implementing the idea of power of three, because when you are trading, you are expecting to be buying below the midnight openings, below true openings, and selling above true openings. So the Sunday's opening, the midnight opening, and the 8:30 opening is the opening prices we are more interested in when trading the indices market. So narrative of market structure states that if an intermediate term high is created in the market and you are bearish, you do not want that intermediate term high to be violated. Now, using that narrative as a contrarian, if that intermediate term high is violated, this is the algorithm telling you that price is interested in higher prices. So the recent low that balanced an imbalance, which balanced a CB, that low is an intermediate term low. So because the intermediate term high has been currently violated, you do not want the intermediate term low to become violated. So the intermediate term low will be like the first stage distribution. So because the intermediate term high has been violated, you're interested in a retracement lower to get a short-term low to rally higher to the long-term highs. Does that make sense? Let me explain in the chart. So now the market does one of two things: either to rebalance an imbalance or go to pair up a pool of liquidity, which are resting as buy stops or sell stops, which are buy side liquidity or sell side liquidity. So when we had this drop lower, let's zoom in so you understand the inner dialogue. So when we had this drop lower, price left these sets of imbalances. we're making use of this imbalance here. This imbalance was the imbalance created after price changed the state of this delivery here. So price left this imbalance here. So when you take your candle and you take the low of this candle to the high of this candle here, you have this CB. This is a CB, a fair value gap. So call this a CB, which is also a fair value gap. Because it's Monday, you are to be nimble when trading. So you are, and because you have already reached a higher time frame drawn liquidity, so you're not interested in expecting the market to deliver a lot of points. You are interested in low hanging fruit objectives. So this is a scalpers market. Mondays, especially after price has reached the previous weeks, during the previous weeks, price have reached a terminus, a drawn liquidity on the higher time frames. So going into these lower time frames, you will be interested in being a scalper in these lower time frames, coming for low hanging fruit objectives. Now, price dropped lower here and left this CB here. So because price does one of two things, goes to pair up pool of liquidity, this taking liquidity, or rebalance and imbalance. So now we're expecting price now to rebalance this imbalance now. Yeah. If you can see from this 1 hour time frame, you can see that this candle here, this down close candle here, was the candle that rebalanced this imbalance now. So dropping down to the 15, we calibrate this, that's 1 hour fair value gap down to this 15-minute fair value gap here, using this as your executable time frame, as your bellwether time frame. So we are interested in the 8:30 opening price, which is the opening price for the New York session. We indicated that when an intermediate term high is violated, that is the algorithm tipping its hand to you that price is coming for higher prices. So we have buy side liquidity resting above here. So for this day's trading, we are interested in, this is our drawn liquidity on this going into Monday's trading, this buy side liquidity. Now, when you have this intermediate term high here, this candlestick, this down close candle that rebalance this imbalance here, and then price dropped lower, this candle, this set of candles that rebalance this imbalance now, this is an intermediate term low. When you're bullish, you would want an intermediate term high to be violated so as to negate the idea of a bearish narrative, to negate any idea of bearish narrative, and you'd want intermediate term lows to be kept intact. So this here is an intermediate term high, and this here is an intermediate term low. So you are waiting, you are being patient like a eagle that is trying to corner its prey. Being patient doesn't mean you do not know how and when to strike. It is the idea of aligning time and action together. So you do not make an action when it is not the time, and when the time reached to take an action, you take an action swiftly, without compromise, without thinking about it. All right. So now, because we are expecting price to come for this buy side liquidity for the morning session, you are expecting this intermediate term high to be violated and this intermediate term low here to be kept intact, to be kept in place. So if you can see this, the low of this candle here is 5,704.4. The low of this candle is 5,705.4. 4.5, which is a tick above this. It does not violate this low. So price rallied higher and violated this high. At this moment when this high has been violated, I do not have the replay button on my trading view so as to prevent me from using the replay function. So, but we can still illustrate what is being taught here. So now imagine that all of this price action, you have not seen it. You're only seeing this candle, this up close candle that has violated this intermediate time high. So this candle here, the 10 a.m. candle, is the candle I'm drawing your attention to. Pay attention to this candle. You have not seen any of these candles. You're expecting these candles to form. So when this candle made a piercing above this intermediate MI, this is the algorithm tipping it down to you that we are going for higher prices short term, or just we are going for higher prices. How high? That is not your concern. Your concern is understanding that we are going for higher prices or we are going for lower prices. So when you understand we are going for higher prices, then you drop down to your lower time frames. So your lower time frame, which is the 5 minutes, the 3 minutes, and the 1 minute. So because I would want this video to be short, so we'll just go straight to the 1 minute time frame. Remember this high here, this is our joint liquidity for the morning session, which is this buy side liquidity. Let's make this right. Now, because we are expecting this high here that you see, this is the intermediate time high on the 15-minute time frame that we balance that imbalance here. Because you are expecting higher prices, you would want this intermediate time high to be violated. And when this intermediate time high was violated here, immediately this intermediate time high gets violated here, you go into the marketplace looking for fair value gaps and other blocks instantly to participate in the move higher. You do not enter when this intermediate time high has been violated. You do not just enter here. You wait. This is the patience we are talking about earlier. You wait. Price will retrace down to a discount PDRA from this range low to this range high that has violated this intermediate high, because now it has been established that we are going for higher prices, because price has negated any idea of it being interested in lower prices. So you take the low of this swing point here to the high of this swing point here, and then you look for the discounted PDRAs. So what discounted PDRAs can you indicate from this low to this high? What discounted PDRAs can you identify? Discount is everything below the 50% of that trading range. So 50% of it is here, and you have this other block here, you have this volume imbalance here, you have the low of this fair value gap here. Does that make sense? You also have this here, you have the midpoint of this wick here. If you take the wick of this candle, look for the midpoint of it, stretch that out in time, you get that. So you are looking for price to come for discounted PDRAs to go higher. Now, in that same idea that was established on the higher time frames, market structure is factor in nature. So when you go to the lower time frames, you implement this idea of market structure down to the lower time frames. Now, in the idea of a bullish market structure, when an imbalance is rebalanced, the candle that rebalance that imbalance is an intermediate term low in this case. So now this imbalance here that was rebalanced here with this candle here, this now is an intermediate term low. So you are not expecting this low to be violated. Now, because we are at a time in which the market generally makes a second stage distribution of a market maker buy model or a market maker sell model. That time window is within the 10 a.m. to the 11 a.m. window. So the 10 a.m. to 11 a.m. window is a time window when a distribution of price takes place. So you have this imbalance here that was rebalanced. Now this imbalance has been rebalanced. Now you do not want the candle that rebalance this imbalance to be violated, the low of the candle to be violated. So you have this low here. You can still trim your entry point. You can still trim your stop losses to get large stop losses, but that's not the point of this review. Now the point of this review is to explain the inner dialogue going into this trading. Now because now this is an invalidation point, you expecting higher prices to go for this buy side liquidity. So when price has violated this intermediate term high, you are looking for a retracement to a discounted PDRA, whether the low of this fair value gap here, you are looking for the low. The low is at a discounted point of a PDRA and this other block here. So you have this open of this other block here. You stretch that out in time. When price comes down here, you buy at this low here, which is just at the equilibrium, and at this other block here, your stop loss below here, take profit above this buy side liquidity. And if you take your measurement, measure this to this is about 10 handles, mixing about 6 handles. You're using 6 handles to make 10 handles. This is doable, and this is a very good risk to reward model. All right, so let's say you miss this entry here, this entry point. Now say you miss this entry point, what do? You look for the lowest body, the lowest candle body at the swing that went first for a discounted PDRA, which is this is the lowest body. You stretch that out in time. That is a rejection block. That is a rejection block. So here you have a rejection block. We'll cover this later on in one of the teachings. So here you have a rejection block. So you place your buy order at the rejection block if you miss this first entry, because you are still within a time window in which price distributes, in which the algorithm goes into a distribution phase. So you place your buy entry here, stop loss here, or at the midpoint of this week, because you're not interested in price coming for the midpoint of this week within this time window till it gets to this your profit. So if this, then this. You are not expecting if this, then this. If this, then this means is price violating this intermediate term low, meaning you are coming for lower prices. But because you are using the idea of market structure in both ways, in both to validate your idea of a bullish narrative and to invalidate any idea of a bearish narrative. Does that make sense? So you are buying here or at this rejection block here, going for higher prices here, and your stop loss here. It is not just price, we are also focused in with time, because time is vital. Every algorithmic theory, the first principle of every algorithmic theory is time. So because we are at a time frame in which the market goes into a distribution phase, so we are expecting so within this window we are expecting a second stage distribution, so which is what we had here. Price comes for this discounted price and then rallied higher. So I hope you got something from this video, and I'll talk to you tomorrow, and goodbye.